welcome everyone. We'll be soon starting, just giving a second for people to join the webinar and get themselves settled in. And I'll make a really slow start here while people gather. So hello. My name is Seren, and I'm the CEO of Equidam. And Equidam is the investor group management platform that provides daily tools to manage the deal flow, pipeline, members, and communication in one place. And we actually had an anniversary just in April this year, where we had our 5 years anniversary. And at that point, we had a really nice collaboration with Equidam, who is on this webinar today. And we decided that the valuation as an important topic is worth redoing, and with a slight angle this time, focusing on the portfolio valuation rather than the methods specifically. So Daniel here is the CEO of Equidam, a platform specifically focused on the startup valuation and how to calculate it. And he will be taking over from me now for this remainder of the session to tell you all about how to calculate the valuation and what kind of methods and Excel table examples can be used. And just also an additional note that we also have the button down in the screen with Q&A. Please do ask questions there. We will have 20 minutes-ish at the end of the webinar to answer your questions. And if you don't have any question on yourself, then please use the opportunity to vote, because if we do run out of time, then the more voted questions will be answered first by Daniel. So
Awesome.
I think that's a good enough introduction. I won't be spending any more time. I'll hand it over to you, Daniel.
Thank you, Seren, and thank you for having us again. Welcome, everybody. So we will be talking also about specific startup valuation, because that's what makes up the portfolio. But yes, today a different angle. We did many webinars already with Equidam, so glad to have another one. So let's get it started. So I hope everybody can see the slides. If not, please let me know. I just started sharing my screen now. So, and let me also see if I can see participants here, just in case there are questions. Awesome. So yeah, welcome. Today we're going to be speaking for about an hour 15 minutes, something like that, depending on how many questions there are going to be. I'll try to keep my side at around 45 minutes. It's a lot of content, so bear with me. But I really hope, to give you interesting information and new information as well. So we're going to have Q&A at the end. As Seren said, please put your questions in the Q&A tab. I'll try to answer them if they're relevant throughout. Otherwise, we're going to go to the end and they're going to be answered at the end. So, so welcome. Yeah. About me, my name is Daniel Faloppa. I'm the founder of Equidam and CEO. I'm originally from Italy, but I've been in the Netherlands now for more than 10 years. I studied finance and investments, but then did now more than 8 years in startup valuation. With Equidam, we did everything from 20K friends and family rounds valuations to the largest one was a 2 billion IPO on the Nasdaq. So seen a lot of things over these years and all across the world. So today we're gonna focus on the point of view of angel investing and valuation and portfolio valuation as well, right? So we're gonna touch a little bit on why valuation, a little bit about Equidam, and then how to set the stage to understand valuation, what actually is valuation, the main valuation methods for startups. We're going to talk about, is it worth calculating valuation at all for startups? And then we look into portfolio participations and then calculation of ROI for which we also have a little Excel file that you'll be able to get after the webinar as well. So yeah, so it should be interesting, definitely interesting on my side. So why do we talk about valuation in the first place, right? And I think we have, as investors, two different points of view, right? We want to look at valuation for the specific deal, and we want to look at valuation for portfolios, right? So for each specific deal, in my opinion, somebody asked me in a webinar, what's the best valuation, right? And the best valuation is the one that makes the startup as successful as possible. Just by default, that's also going to make investors as successful as possible. So that's what we try to converge onto. So what does it mean, right, to make this a startup as successful as possible? It also means to have current and future investors with the best incentives, right? To keep on investing, to invest in the next initiative of the founders, to invest in, spin-offs of the company, whatever it may be, to support the company in a rough patch, or not support it in case that's the best decision, right? And on the other hand, we want to have a valuation that allows funders to have the right motivation to run the company, through thick and thin, and be successful as well on their own, right? So that's one aspect of why valuation is important. The other aspect is for portfolio itself. Like, do we know more or less if we are deploying the right capital at the right time, right? If overall the portfolio is, if overall this is a good moment to deploy capital, or it will be better to back off from the market right now because valuations are overall too high. Or if we should expose ourselves more to the startup market because we're actually in a good moment for startups right now, right? So these type of questions, I think, are just the higher level on why valuation matters, and sort of also what we try to work towards at Equidam. So just about us and why are we speaking today about these topics. Equidam is a valuation technology used in 90 countries to value startups. Is used by investors, is used by the startups themselves. Our goal is really to make sure that valuation is not a deal breaker when fundraising. So we really focus on this segment of the market. So far, we valued more than 130,000 startups. Actually, I think now it's 140. Around the whole world, and we work with an array of partners as well. So, but that's enough about us. So, why do we talk about valuation in the first place, and what is valuation, right? So, from a financial point of view, a company is a risky investment, and which in finance basically means it has a variety of outcomes, right? It can be very high, can be very low in terms of its value at the end of the investment period. The value then of the investment, or the valuation of the company, is the amount an investor or the market would pay for a specific amount of return and a specific amount of risk, right? So this is there is a little caveats to this. Like, this is what we are looking at is we're looking at return on capital, right? Because this is sort of the most objective way for valuation. But there are other components that end up as part of the price of the deal, right? It could be personal brand of the investor, of the startup, personal return, some other return. Think about, family members investing in the company. They have a different type of personal return as well. Maybe environmental concerns that a lot of companies, including us, are trying to include in the valuation, but obviously, not as easy for now. Image concerns, for the fund, maybe for the portfolio. Future enjoyment as well is part of it, right? Do we like to work together or not? Especially when we're talking about angel deals, right? So what we consider for the calculation of fair valuation, and what is kind of the objective way for now to calculate valuation, focuses on return on capital, right? And when we talk about return on capital, we talk about risk and return. I think it's always a good idea to keep in mind the other things, right? So we're working on valuation based on return on capital as a baseline, right, to then make investment decisions with a more informed approach, right? So when we're talking about risk and return, they are both about the future of the company, right? So when we talk about valuation, it's always about the assumptions on the company, right? And the assumptions are based on the future, and they're based on the story that the company tell, right? In general, everything else like is sort of mathematical, right? So if we agree with the startup on its return and its risk, we should also agree on the valuation, right? So when we talk about the return, right, we're talking about the potential. So let's say the average future scenario that this company is going towards. And when we talk about the risk, we're talking about the variability of that scenario, right? So little risk would be little variability, while larger risk would be a huge variability of this return, right? So all the valuation methods that exist today are basically trying to proxy in some way these two components, right? So broadly speaking, we can divide the valuation methods in three aspects, right? The ones that look at the past as a way to understand potential risk and return, the ones that look at the present as a way to understand risk and return, and the ones that look at the future, right? So if we look about the past, George is asking, what about value investing risk, lose your investment? Yeah, exactly. So that's the risk, right? So the variability of the return is the risk. When the variability leads the company to zero, that's when you lose the investment, when you lose the money that you have invested, right? So but if the risk is very well, stock can be variable but not risky. In finance, those are exactly the same thing. So if there is no variability, if the price is fixed, like it's very, very stable, that is little risk. If the variability is huge, that is more risk. Yeah. So yeah, so when we look at these methods, right, we have in the past, we have like book value, cost to duplicate. We'll talk about their applicability to startups. But when we look at the present, we look at multiple scorecard and checklist methods. When we look at the future, we look at discounted cash flow, VC method, and real options. And I just want to give you sort of a broad understanding of them, right? And then, of course, like there is always a lot of detail on each of them, right? But we want to understand how to value a startup before moving on to how to value a portfolio made of startups, right? So book value and cost to duplicate, they are good methods for certain circumstances. The book value is just the asset value that you can find in the books of the company, right? In the balance sheet of the company. And cost to duplicate is an estimate of like how much would it cost to duplicate the company as it is today, right? So as you can clearly see, these look mostly at the past, right? But they look at the past as a way to understand what could the company be worth in the future in order to understand its return and its risk to some extent. The pro of these methods is that they can give a useful baseline. You know, they are generally on the low side of the methods estimates. Yeah, they give you a lens on the past of the company, which other methods don't give you. And they can be useful when, you know, maybe when the team will not continue, you might be interested in selling off the company or the assets of the company. These are the methods that come very handy in that. The cons of them are that they are backwards looking. So if they don't tell you a great deal about, you know, how the future is gonna be. The accounting rules are always very conservative. So for example, book value is always fairly low, and digital businesses are creating a lot of intangibles that are not really measured in accounting standards very well. And, you know, they generally give you a low estimate. So if we move on to the present methods, we have multiples. I'm sure everybody's familiar with multiples, right? We want to apply a revenue or an EBITDA multiple on the specific company revenue or EBITDA or any other underlying metric, right? where a multiple is an average of multiples of similar companies, right? So we're basically, my analogy is always we're talking about a price per pound, right? It's just that companies are not measured by pounds, but they're measured by revenue or EBITDA or so on, right? The pros of this is that it's like super quick and super easy to do. The difficulty is that it's very hard to find reliable data, and so hard to find reliable valuations, right? Without finding reliable data. So the other thing is that for early stage companies, the ones that don't have reliable revenue or reliable EBITDA, like we believe these are like multiples are just too simplistic. This is too simplistic of a method for having an interesting picture of startups, and we'll see what that means in a second. Scorecard method, it's very interesting. It's a refined comparison for early stage companies. We're trying to understand how does the company score on some criteria. We chose this 6 criteria on Equidam. And we try to understand if the company is better or worse than those in those criteria compared to its peers, right? And then if it's better, it's going to be worth more. If it's worse, it's going to be worth less than the average company, right? It's a very interesting, detailed qualitative analysis, and it also allows you to specify and to codify investor experience and investor preferences, right? Do you think the team should be accounting for more than 30% of the value of the company, for less of it? You know, what does your experience tell you? You can adjust these things and get to include that, codify your experience in that. The cons is that it doesn't really look at the financials much, and it's difficult to find comparable data. Again, it's kind of always difficult to find comparable data for startups, but we do the best that we can. Checklist method, right? Similar, very similar. This is more like an asset method, let's say. So we are basically giving a certain maximum value for each of these criteria, and then we try to understand like how far is the specific startup from the maximum, from the best startup. So let's say the best startup team can be worth 4 million. How much of the best team is this specific team that I'm trying to value? So another view at the same information. Again, detailed qualitative analysis. Again, it allows you to use your investor preferences, but kind of the same cons also of the scorecard method, right? So if we look then towards the future, we have discounted cash flow. It is very subjective. We'll talk about the difficulty of valuation in a second. So if we look towards the future, we have discounted cash flow, like the Cadillac, let's say, of valuation methods. It's used to value everything from oil rigs to mortgages to anything. It's also used in startup. We believe in its usage of startups because it allows us to have another lens on the startup risk and return profile. So it allows us to look in detail in their financial future. It also puts the return in a broader context, because when we talk about discount rate, cost of equity, WACC, we are comparing this with all other investments in the world. Basically, that's what the method does. The cons is that obviously it doesn't have qualitative analysis, and it's quite sensitive to these discount assumptions. And actually, we have Dhirendra asked, how do you calculate the cost of equity? I mean, for the cost of equity is just a formula, right? So, you can look it up. We can show it afterwards. But and the components of it in general, what we find works quite well is we use Professor Damodaran's databases at NYU, and he publishes a lot of the defaults that a lot of the professionals use for calculating cost of equity and WACC in general. Yeah. So VC method, again, looking at the future, this is quite interesting. It's a very simplified way of trying to estimate the exit value of the company. And then trying to understand how much return do I want as an investor for a company in this stage, and then using that return to calculate the current price, basically, to calculate the current valuation, right? So the pros is that this is very quick, it's very easy to do, and then it keeps, it focuses on the end goal, which is like, okay, like how big can the exit be? Can this company really manage to achieve a sizable exit, an interesting exit? The cons is that, yeah, it is very sensitive to the discount assumptions if you try it, especially if you look at a horizon of like, more than 5 years for the projections. And it's a bit simplistic, like, but again, it's another point of view, right? So we have a question, how do we calculate beta? So beta is a component of the cost of equity, right? And for that, so yeah, a lot of the finance industry is really hung up on the calculation of beta, but, many theories are like, many theories talk about the convergence of all betas to 1 in the end, which would be completely non-correlated with the market. For us, we use a 4-factor beta, which takes into account like stage of development of the company, number of employees, profitability, like several things. And you can look it up on our methodology paper. We have a methodology paper online, and then we explain exactly how we calculate that. And Urs says for a copy of the presentation, yeah, that's going to be available, I'm pretty sure. And then we're recording as well the video. So the video is going to be available as well after this one. Yeah. All right. Then real options. This is also a very interesting method. It tries to calculate the value of the startup based on the value of all the future options that startup has. So it considers the company as a bundle of future opportunity, which it is in this point of view, and then it calculates the return and the probability of the variance of each option. And then, if we sum all of them up, we get to the total value of the startup today. Extremely interesting, extremely applicable to startups. Unfortunately, it is very, very difficult to calculate because we need to calculate the probability not only of the main scenario for the startup, but of all scenarios for the startup, which is very, very hard to do. So in the end, for startups, we always consider this circled method as not really applicable, not really the best. So for example, on Equidam, we provide the other 5 that you can see here. So why are we talking about all these methods, right? So the main wisdom, right, is to always use more than one. And you saw, as I was talking through them, that they all have their point of view, right? So on the risk and return, right? Maybe one looks at investor required return, another one looks at how do they compare with other startups in the same early stage, another one looks at how do they compare with like investments, like the discounted cash flow against other investments, and then real option, how do they sees the company as a bundle of opportunities and calculates the valuation of each one, right? So that's because there isn't just one way. So if we can, combining more than one method is always the better way. Each method has different biases as well. So by combining more than one, we put them together. And we reduce those biases. So for us, like what we saw working well on our interface is that we have qualitative methods like the scorecard and the checklist as a baseline. They take into account the potential value of the company, but the company still hasn't set on any specific strategy. So these methods don't look at the specific strategy. Then we have a VC method that we see is relatively stable in the middle of the calculation. And then we use discounted cash flow to account for specific plans, right? So a company might be like deciding on a plan, but they're still not very sure. They still have to test a lot of assumptions. It's good to have a balance of these methods because the company still has a lot of potential and the plan could change. So we don't only use DCF, for example. Which kind of leads us to what we do, just to give you a little bit more context. like our platform is really meant for the calculation of startup valuation. So you can fill in 34 multiple choices questions. You fill in your financial projections for the startup. We put this together with a bunch of data about, you know, how to calculate all the discounts, all the various methodologies that I just showed you. And then the output is a valuation report with our 5 valuation methods and 24 pages long and so on. So we try to make all of this very effective, let's say. But I mean, we have a very open methodology. You can do a lot of these things on your own, but it's just important to understand, I think, the concepts of this more than anything else. So the question is it worth it to do all this, right? To calculate the value of a startup investment or a potential investment even, right? And the thing is that, like, some calculation is done, right? Whether it's just taking the given price, right? That's also a choice, right? So the question is, like, how far do we want to push our analysis, right? And if you take the current market price, right? What we're seeing right now, and like what we saw in our experience, is that it wasn't correct for a long time, right? In the past 15, 20 years, at the beginning of the period, startups were very undervalued, right? And then valuations came up and up and up and up. And then we got through COVID, where basically we peaked at what a lot of people consider excessive valuation for startups. And now we are again down to, you know, levels between 2017 and 2019, maybe. And yeah, you know, like, if you just take the market price, you are taking these trends, right? And that's fine, right? You might save enough on analysis and thinking that's fine for you, but it's just good to be conscious about it, right? And then, you know, there are also things that maybe are not going to be the same in the future, broadly speaking, about the market, right? So 20 years ago, you could expect, like, you know, a startup to go after a relatively simple service and to have, quote unquote, little competition and be able to grow to a dominant worldwide position, right? Right now, because of the costs of creating digital companies came down so much, competition is at a different level. So, you know, do we still want to pay the same valuations that we used to pay or not, right? So these are all considerations that go into this understanding. Then, you know, obviously, the more mature the startup, the more it's worth to investigate valuation. First, because it's easier, and second, because just the amounts are larger. They allow for, you know, it makes sense to spend more time and maybe to spend even money in investigating the valuation of a potential deal. And then, yeah, the other thing is that with the usage of tools, right, the cost of doing valuation decreases, right? But basically, if you think about it, it's always a spectrum, right? You always do a valuation. It's just about, like, how do you set yourself on a spectrum from just taking the given price, right? And from on the other end of the spectrum, conduct an all-out valuation exercise, right? So you don't need to do either of those things. You just need to choose, like, where you want to be in this spectrum, right? So obviously, and also, like, this could change on a deal by deal basis, right? According to, like, what are the amounts involved, like, what are your, you know, preferences, your experience, the stage of the company, the risk of the deal, right? All these things come into play when deciding how much time to spend on valuation, right? The funny thing is that it's also always a game of averages, in a sense, right? When you are taking the given price, you are just basically taking the broader average. You're not even looking into more details, right? And when you conduct a super precise valuation exercise, what you're doing is trying to find a very specific data to compare the company against, a very specific but in the end, it's always an average, right? You're maybe going to find the average of the multiples, let's say, of very specific SaaS companies in, you know, south of Melbourne, all doing the same thing, right? So yeah, the funny thing is that the spectrum also goes from taking a very broad average of valuation and just, you know, accepting it, or getting very specific. And again, the more specific you get, you have a cost to get there, of course, right? It takes time and potential resources as well. So What about portfolios, right? So if valuation on a single deal is relatively important, valuation on a portfolio becomes extremely important, because we could be, if we are serially wrong, then we're just going to be, overall unsuccessful, right? Depending on every person has its own goals, obviously, but, in general. So when we think about valuation for a portfolio, like if we don't know of errors or biases, we're going to repeat them, right? The other thing is that generally valuations rely on peers, right? So if we start having an issue and setting a precedent, then the next valuation is going to be based on that wrong precedent, right? So this is why we have real estate bubbles, right? Because all the prices are based on other prices. And then, if you just do like on each single startup a different valuation, like the errors are going to be diversified away, but portfolio biases are not going to be diversified away, right? So important to reflect on valuation when managing portfolios, basically. So how to calculate portfolio value, right? We're not going to spend a lot of time on it because it's very simple. It's just the sum of the values of each participation. So it looks fairly simple. There are a few things to keep into account, right? So the timing, like how often do you want to value your portfolio? Quarterly, semi-annually, yearly, every 5 years, generally we see, especially on angel investments, like yearly or even less than yearly, depending on how active the portfolio is or not. So there are questions there. Efficiency, obviously, do you have, are there tools that can help you, that you have dedicated people that can help you, or how do you gather the data from the companies as well? What we see with a lot of investors is that this aspect is very, very difficult. So if it's difficult for you, don't feel bad. That seems to be one of the most difficult things in calculating portfolio values. And then there are a lot of tough calls, right, to make. So if we need to have write-offs, right, it would be good to have them, to front run them, to not wait for the market to show them, but anticipate them. Again, be ahead of potential market pullbacks, and also try to be realistic about potential exit valuations. Like sometimes, we calculate portfolio value based on like the private valuation of a company that maybe was set by a Series D that had very, very convenient clauses for the Series D investor. And they really didn't care about setting a proper valuation. But then if there's going to be an IPO or a company sale, that valuation will not hold in that context. And so it's not going to affect the return of our portfolio, right? So this is quite kind of an interesting thing. I think a great article on this is from AVC, Valuing a Venture Capital Portfolio. So take a look at that if you want to see a little bit more. Because for us, we're going to look a second on the next thing, which is, so like the portfolio value is interesting, right? That, I don't know, like your portfolio is worth, 1 million, 10 million, 100,000, whatever it's worth, interesting, right? But what's even more interesting is to calculate the ROI, right? How much is it growing, if at all, hopefully, and is it compensating, the risk that you're taking? Could you get, if you can get the same return on something safer, right? You probably would, right? So it's important to calculate return on investment, return of the portfolio, but it's not that easy. So we're gonna attempt to do it now in 3 methodologies. So let me show you, and then we're gonna share also this Excel file so you can make a copy and just use it however you want. But I thought I had I do have one more slide. Sorry about that. So the ROI, right, is just in theory the value of the portfolio at the end of the period divided by the value of the portfolio at the beginning of the period, right? So if we invest $1 million and now that $1 million is worth like 3 million, right? That's clearly 3x return, right? 200% growth of value, 200% ROI. So that's yeah, sure, that's easy. The problem is, especially for any type of portfolio really, is that there's gonna be more capital invested throughout the year, basically, or throughout the period, because there's gonna be opportunities. You know, you're not gonna commit exactly like, you know, $1 million to startups for the next 10 years. You're going to set them aside at the beginning, and then you're never going to add or remove any capital from there, right? Portfolios need to be balanced and adjusted throughout time, right? So capital injections and withdrawals need to be taken into account in the calculation of the return on investment. And that makes it quite complicated, to be honest. The best way to think about it and to simplify a little bit the financial calculations is that instead of like thinking about the start value of the portfolio as the value of the portfolio on day 0, we're thinking about it as a weighted average of how much cash that is in that portfolio, or what's the average what's the average cash in that portfolio in the time period, right? And let me show you how it works. So we have an easy version, a medium version, and a hard version. And I'm sure if we were to go even in more detail, there would be like an extra hard. But each of them has their place, right? So the easy version is what we said just now, right? So we have a end value and a start value, right? And we can change, you know, our horizon here. We are looking at 2021. 1st of January, 2021, 31st of December, but this could be like, you know, 2025 or something, right? So, and then we have a beginning portfolio value, in this case, $1 million. Let's say it ends up being, you know, $3.5 million, right? So this is now a period of 5 years, right? And then this is the total return, right? So the total return from 1 million to 3.5 million is 250%. And then we want to look at the annualized rate of return, so ARR, also called IRR or annualized IRR, so internal rate of return, also called ROI, many names, which, to be honest, they are just exactly the same thing, at least when we look at it so in a simplified way like this, right? So this is what we showed before. Again, feel free to use this file. It's going to have all the formulas unlocked and everything, so you can see exactly what it does, and you can extend it and do whatever you want with it. So yeah, you know, again, so interesting, right? So over 5 years, our portfolio does 250%. It means that it does 28.4% per year. Is this good? Is this not good, right? Well, you know, returns are not good or bad. The question is like, okay, could you have done the same with less risk, or could you have done a higher return with the same risk, right? In that case, you are sort of suboptimally investing. Again, not easy to determine by any stretch of the imagination, but I seem to remember that like for VCs, we're looking at 20% per year for successful VCs. Then it depends, because now the interest rates in the markets are higher and stuff. But so, you know, an angel investment portfolio is going to have higher risk than a VC portfolio. It should theoretically have a higher return, right? Again, we're thinking about monetary return. So if a lot of angels have returns that are not only monetary, right? So maybe you would be willing to accept the same return of a VC portfolio, but, you know, it allows you to have fun, to work with young companies, to try to help them, you know, there are many reasons. But if you look at it from a strictly financial point of view, the risk that you take should be compensated by the return, right? So this is the easy way, right? So what happens when I have a deposit, right? So let's say that mid through this period, right, I decide I want to invest another 200K in my portfolio. I found a new startup is very interesting, or you know, I liquidated some oil futures or something, and I want to invest this 200K in a new startup. And then let's say that because I invest this 200K, my expected return is going to go to, you know, 4.5 million, right? Is this the correct return? Well, clearly is not, right? Because this is calculated on a 1 million basis, but now we have an extra 200K in this portfolio, right? So how do we go about that? And that's where the medium comes in, right? So this is a case, right, in which, okay, so we have the portfolio value as before, but then we have multiple deposits and withdrawals within that time, right? Within that period. Again, here we're looking at a year, but you can make this 5 years, you can make this 10 years. You know, this allows you to calculate ROI by only having two calculations of the value of the portfolio, right? At the beginning and at the end, plus all your withdrawals and deposits throughout. So basically how it works, and that's, you know, what I think is the most important thing, is to understand how it works. So this now becomes incorrect, right? This is wrong. This is the same calculation that we were doing before is wrong, because like we're not growing 60%. 150K in this 1.6 million are just more money that we deposited, right? So the way that this works, this is the modified Dietz calculation. It basically assumes that like we want to understand what was the average cash in this portfolio. So we started with 1 million, we injected 150K at the end of March, and then we withdrew 50K middle of April, basically, right? So the average amount of money that this portfolio had in this period, in the period of 1 year, is gonna be 1.078 million, right? Yeah, exactly, Eric. Time value of money affects the ROI relative to the time of each investment and withdrawal. Yeah. So this is an approximation, because if you wanted to have the perfect calculation, you would have to do a portfolio value every time you do a withdrawal or a deposit. But I don't think that's realistic for angel portfolios. That's why I'm making the Excel like this. But this is a good approximation. And then you see that instead of being 60%, the return in this case is 48%. If we were only to have withdrawals, right, the return would be higher, because, you know, the return is not only 1.6, but it's 1.6 plus the 50 that we took out, right? So that's how it works. And then again, we are going from a total return to an annualized return, because we're interested in comparing this with other types of investments that need to be compared for the same periodicity is a word, for the same period, right? Annualized period. Okay, so this was medium. So if you're still following, what's hard, right? So hard is when we get a little bit more granular with our portfolio valuations, right? We decide to value our portfolio, in this case, every year. So we start at the 1st January 2021. We value it again end of 2021, end of 2022, end of 2023. And in between, we have deposits and withdrawals at disparate dates, right? So March and like July and September, whatever, right? So as long as we keep the valuations of the portfolio regular, then these calculations, again, an approximation, but they're going to be a good approximation. So how do we get then to the return in this case? Well, we basically do 3 times what we did in the medium scenario, right? So this is the weighted average of cash in the first year. This is the weighted average in the second year. This is the weighted average in the third year. We calculate HPR, which is what we were calculating before, holding period return. Portfolio managers like acronyms, apparently. And then we can sum up the 3 returns of the 3 periods, and then again calculate. So this is the total return. So then we need to go to annualized return if you want to, if we want to compare it with other things. So yeah, it's an extremely interesting field, the one of calculation of portfolio returns, because of these problems. But again, it gives us I think insights in how the portfolio is doing, and yeah, definitely important to track. So again, this is going to be shared with you. I'm sure there is software that does this. You know, we haven't looked into it too much for now. So, you know, maybe somebody knows already, but I think, again, the principle is the important thing to understand. And then, you know, unless you're doing it professionally with many companies, you can probably do it on your own once you understand this type of things. So yeah, I think this is what we had for you today. And yeah, bang on 45 minutes. I would like to tell you, please connect with me on LinkedIn. We are always happy to try to answer questions, and, you know, anything that you may wonder about valuation. And yeah, feel free to email us at info@equidam.com, or we have more resources on our blog, or our all our templates are on equidam.com/support. Not yet this ROI calculator, but we're gonna include it there soon. So with that said, we can move on to questions right now. And we have already two. Now, how do you calculate the cost of equity? We answered, right? If we have time, I can show you more details. And when should you value a company using a revenue multiple versus EBITDA? That's a good question. So the multiple is problematic because you need to use very similar companies, and very similar companies for startups are very, very hard to find. And the multiple should be higher when the company is more risky. So when you take like a public market multiple or a multiple for Series B companies and you apply to seed, it should increase. So yeah, it's already problematic on its own. Then you get into questions like, revenue or EBITDA. So in theory, you should use the multiple. Given that there is all this uncertainty, you should use the multiple on the least uncertain thing, you know? So if the startup has like super scattered revenue because, you know, they close one customer and they tripled their revenue or something, then it's very difficult to apply a revenue multiple. But it's also very difficult to apply an EBITDA multiple. So for us, what we do is that we apply the multiple at the end of the financial projections, and then we discount it with a discounted cash flow. But so because we want to have a little bit more reliable parameters for the company, which is crazy, right? Future parameters, can they be more reliable than current parameters? Well, if a startup is very young, maybe, you know, because the specific like revenue of the last 12 months, how is it representative of the revenue of the next 12 months, right? And the same for the EBITDA. So what we do is that we use the EBITDA because we prefer to include the specificity of the cost of the startup and not just to sort of brush that issue and just look at revenue, right? But, you know, case by case, I would say on the one that is more, if they are the same reliability, quote unquote, EBITDA gives you more specificity in the valuation. And so your valuation is less average and it's more interesting. Yeah. Long story for a short question. Eric is asking, what's the relationship between Equidam and Dilom? It's a friendly one, you know. We're like working in the same environment, talking to the same people. Dilom, I'm sure you know. I mean, I'm sure Seren can say it better, but is management for angel networks, and for us we are on valuation, so also for investors and startups and angels and networks and so on. So for now, that's our relationship. We really try to bring this knowledge to the environment together. Yeah. Awesome. We don't have currently any Q&A on the chat, but so let me show you just a second if I can find it. How do we calculate cost of equity, which was a question before. So if you just go on equidam.com/methodology, you're going to be able to find our methodology for valuation, more detail about the methods that I explained. Daniel says, thank you. You're very welcome, Daniel. Really, really, no problem. And so here at some point we show how to do discounted cash flow. And then in this case is, I thought we had the formula written easily here. But it's basically the cost of equity is risk-free plus beta times market risk premium, basically, right? And yeah, so that's how we calculate it. And then, yeah, so the market risk premium is from Damodaran, like fairly easy to find what is the risk premium of the market compared to the risk-free. So how much are stocks returning on top of just the risk-free rate, which is generally the 10-year government bond. And then risk-free is the 10-year government bond. So the kind of return of the less risky asset that you can buy, generally US treasuries for 10 years. And then the beta should be the correlation between the company and the industry, right? So again, the theory there is long. I'm happy to go into that. It's super interesting. But when it comes to startups, startups are not very correlated with the industry, right? Or they're not very correlated with anything because, yeah, they're startups. Nobody knows how to predict if they're going to be successful or not, you know, even less how that success is correlated with other things, right? So very, very, so, you know, if the correlation is 0, then the beta is 1, right? So for a lot of even large companies and conglomerates, the beta is just 1 from a lot of analysts. But you can get as deep as you want in that story. And so for us, we use a 4-factor beta, which again is a combination of the industry beta, so the correlation with the industry, but also the size of the company, number of employees, and profitability, which have been found to be correlated with the risk of startups. So we adopted that model. Wasn't researched by us. I forget who did the research on that, but we decided to adopt that calculation for the cost of equity. Yeah.
All right. Thank you very much, Daniel. It's great listening to you and learning more about it, about all the methods and ways to calculate. And thank you to everyone who participated. As Daniel mentioned, we will be sending a follow-up email to all of you with the materials and the links to resources. And of course, you are welcome to kind of go and dig deeper on Equidam's own website as well. So wrapping up for this time, thank you very much, everyone, and have a lovely evening.
Thanks, everybody. Have a good evening.
Yes.
Thank you, Sam.
Bye-bye.
Bye.